Now we are continuing with the further aspects of the corporate governance. First of all, purpose and scope of the governance. For the private sector, what does private sector mean? Private sector means privately owned organization. Either it could be public limited companies which has investment of shareholders, or it could be family owned companies, or at times there are companies which are managed by family because family has 51% shares and rest of 49% are issued to public in stock market. So company is not completely a family owned company, but company is managed by the family because their shareholding is 51% or more. So for private companies, corporate governance is very important because they have different shareholders. Family-owned company is the one which is managed by the family. So here corporate governance is not very much important. But corporate governance is important in this type of companies and as well as in this type of companies where most of the shareholders are not involved in decision making. Although they are not in power, that's why they are called non-controlling interest or minority interest, but it is the responsibility of the director, non-executive director, chairman of the company to protect the interest of non-controlling interest or minority interest. So for a private sector to monitor those parties within a company which control the resources owned by the investor, which control the resources owned by the investor. Management is the one which control the resources which is owned by the shareholders. So as we discussed at the start of the lecture, that management is working as agent of the shareholder. It is an principal agent relationship, or it is called agency theory, where it is the responsibility of the management to protect the interest of the investors or shareholders. Primary objective of sound corporate governance is to improve corporate performance. Corporate performance improvement means increase in profitability. Whenever we talk about the efficiency and performance of the business, it means we are saying that the profitability of the business will rise and accountability. So accountability means transparency will rise. Shareholders can ask questions to the directors of the management, and directors of the management are liable to answer the concerns of the shareholder. So a culture of increase in profitability and transparency in creating the long-term shareholders value, which means in maximizing the shareholders profit. Shareholders value increase means you are providing them capital gains, and apart from capital gain, management is capable to provide them good dividend from profit after tax because they achieve their targets of profit, or they earn more than the targeted profit. So this is what we expect from a private sector company, right? Any questions? Okay. For the public sector and not for public sector organization. Public sector means completely government. Here we talk about the government organization. Government is responsible to protect the finance of finance of taxpayers. Basically, government is utilizing the finance or funds which they generated from the different types of direct and indirect taxes. So it is responsibility of the government to provide value for money. It is responsibility of the government to provide uh, health, to provide safety, to provide communication structure, schools, and employment opportunities or business environment in which most of the new companies or new businesses will be willing to invest, and they would like to create as many job opportunities as they can. So it is the responsibility of the government to utilize the taxpayer funds in an effective way, which will provide value for money to the society, which will add value to the society, or which will add value towards the different less privileged or poor people of the society. Objectives within these organizations are more complex and conflicting. Conflicting, what does it mean conflicting? Suppose if we say that government should provide good quality education just like private organizations, if they will try to do this, they have to incur huge costs. So when they will incur huge costs, then you will raise a question that you are utilizing the fund of taxpayers, and from the taxpayers fund, you are not only to expected to co-incur or resources only on education. Similarly, if we want them to increase number of hospitals, government hospitals, and increase number of government doctors, government facilities, paramedic staff, they will incur cost on it. When they will incur cost on it, or they will utilize most of their resources, we can ask, or we can raise the concern that you are utilizing taxpayers fund only in one area. So that is why it is a conflicting objective. If they try to fulfill the need of the one segment, it affects the needs of the other segment. So government try to fulfill the needs of the maximum segments of the society with the available resources or with the tax collected from the public, from the taxpayers. So this is called what? This is called conflicting objectives. Organizations are often appraised with value for money. Value for money means three E's. Three E's is the concept of economy, efficiency, and effectiveness. What is this economy? Economy means you should incur lowest possible cost, measure of input to achieve a certain service or level of service. Basically, economy tries to minimize the cost, and it tries to maximize the benefit which is expected from the taxpayers' fund, or without compromising the quality of our product or service, we want to achieve the targets. This is called economy. Then we have effectiveness. Effectiveness means ultimate objective must be met. We want to achieve the ultimate objective. If suppose government is utilizing the funds on carbon emission, then there must be significant reduction in pollution, and there must be improvement in the greenery, or there must be reduction in the temperature. So if it is achieved, then we can say that target has been achieved or effectiveness has been achieved. Efficiency means measure of outputs over input. Efficiency means you are trying to utilize your resources effectively. Basically, you want to maximize your output against input. Now, maximization of output against input does not mean that you are going to put 100 units, sorry, 1000 units as input, and we expect that you will produce 1010 units. We expect that if previously your output was 900 and your loss or wastage was 100, this time you will improve this 900 to 920, and you will control your loss from 100 to 80, and gradually you will increase your this ratio, and you will try to make sure that there will be 100% output against the input, or if 100% is not possible, then you will try to minimize the normal loss or wastages. So this is the objective of the efficiency, that we want to reduce our losses or we want to reduce our wastages. Clear? Any question regarding public organizations? The other one are not-for-profit sectors. Not-for-profit sector organization is also called or are also called NGOs, non-governmental organizations. They are working in the society or they are working in the environment. And what is their objective? Their objective is to provide welfare to the society. But the not for profit seeking organizations are also not utilizing their own funds. They do not have their own resources, or in fact, we can say that it is not possible for them to fulfill the promises which they made with the different segments of the society without the help of the donors. So they are utilizing the funds of donation, funds which they gathered through donation. So their objective is what? Their objective is to raise funds from the donors or from the one who have high resources, financial resources in the society, and such type of organization wants to utilize their resources towards the poor people of the community or of the country. So once again, it is very important for them to utilize their donors fund in the form of value for money or in the form of CE. Basically, they are also facing what they are also having shortage of resources and shortage of funds. The donors are not providing them huge sum or they are not providing them infinity financial resources. They have limited financial resources, so that is why it is expected from the not-for-profit seeking organization or it is expected from the NGOs to utilize the financial resources effectively and which will provide value for money to the users and there will be economy, efficiency and effectiveness with the available funds. Defines as the performance of an activity to simultaneously achieve at the same time we want to achieve all three E's, economy, efficiency and effectiveness. So purpose and scope of the governance I discussed with you that private sector organizations are divided into two types of organizations. One is called public sector or public organ limited companies and the other one is called private limited companies. Public limited companies are the one in which shareholders are the owners of the business, but the private limited companies are the one in which only family is the business. Then I told you that public limited company is at times managed by a family because it was started by a family as a startup, suppose 30, 40, 50 years ago, and now family owns 51% shares. That's why they are involved in the decision making process. But rest of the 49% shareholders are called non-controlling or minority interest, and it is also the responsibility of the family or 51% shareholders to protect the interest of minority interest or non-controlling interest. Then we have such type of organizations, public and not-for-profit seeking. Here, public means government organizations and not-for-profit seeking organizations are NGOs. Both wants to utilize the either funds of taxpayers or donors in an efficient way, and they want to maximize the utility of three E's, which is called efficiency, effectiveness, and economy. Right? Any question related to value for money or public sector organization or private sector? Okay. Then we have agency theory. I have already explained this agency theory more than once during the lecture that agency theory is the concept describing the nature of agency relationship driving from the separation between ownership and control. Principal, it is also called what? It is also called the principal agent relationship. Now, who is the principal? Shareholder is the principal because he owns the company, and directors are the agent because they are utilizing the financial resources provided by the shareholders, or they are utilizing the funds provided by the shareholders. So they are working as an agent, they are managing the company, and their responsibility is what? Their responsibility to add value in shareholders' wealth. It is their prime objective. If they will add value in shareholders' wealth, definitely they will be able to achieve other objectives as well. So this is called what? This is called principal agent relationship. They are directors are what? Directors are held accountable to whom they are accountable in front of the shareholders or in front of the owners of the company. They are employed on behalf of the shareholders because they are trying to add value in shareholders' wealth. This is called agency theory or principal agent relationship. Although in agency theory or in a principal agent relationship, it is also expected that there will be some conflicts between the shareholders and the management. The shareholders want to maximize their wealth, but on the other hand, management wants to achieve their own objectives or their own targets. So there could be some conflicts between the shareholders and the management, which is something not surprising for any organization. So this is called what? Principal agent relationship. Then we have key concepts of agency theory. What is this key concept of agency theory? But before moving further, is there any question related to principal agent relationship? Okay. First one is an agent is employed by a principal to carry out the task on their behalf. As I told you that they are hired by the shareholder. Agency refers to the relationship. I have already told you principal agent relationship. Agency cost. This is something which is a new word. Agency cost is basically salaries and benefits which are offered or which are provided by the uh, shareholder to the managers and directors of the company. By principal and monitoring agency behavior because of lack of trust in the good faith of agent. And agency cost also refers to what? It also refers to external auditor's fee. Basically, they will hire external auditor as their agent to overview the financial statements, which are the responsibility of the directors or senior management of the company to prepare. So this is the agency cost. Apart from this, they will bear the cost of non-executive directors, those who will charge for their each visit either on per hour basis or per day basis, and management will also provide, or company will also provide them like meal, stay, and such type of expenses. So non-executive director is also another agency cost, which is, and both of they are trying to make sure that financial statements are free from material misstatements because of lack of trust. By accepting to undertake a task on their behalf, agents become accountable. As I told you that it is the responsibility of the directors to present transparent financial statements to the shareholder because they are held accountable in front of shareholders. Directors have a fiduciary responsibility. Fiduciary responsibility means they have the legal responsibility to perform to the shareholders as of the organization usually described through company law. As I told you that legal responsibility as operating in the best interest of the shareholders, and best interest of the shareholders means add value in the shareholders funds or maximization of wealth. Then we have 6 point. Stakeholders are any person or group. As we discussed that stakeholders could be customers, suppliers, government, anyone. So they are also affected by the policies or activities of an organization. So that's why directors will not only protect the interest of the shareholders, but they will also protect of the interest of the other stakeholders as well. Agent objectives are what they want higher salaries, they want large bonuses, they want status for a director, they want promotion, will differ the principal objectives because if company will incur these costs on this, then how can will they be able to pay good dividend to the shareholders? So that's why there is a need of a balance that a certain percentage is paid as bonus, as increase in salary, or as privileges to the management. A certain percentage is paid as dividend to the shareholder, and a certain percentage is retained as retained earnings in the reserve for the future investment. So there needs a balance to be maintained to avoid any conflict. We don't want to discourage the management because they are working for the growth and prosperity, but as well as we don't want to discourage our shareholders. Most important agency costs are the external fees. As I told you that external audit fee is the very important agency cost. Attending meetings and reporting both annual reports and analyst report. I told you that analyst is the one who will conclude on the basis of financial statement either to hold the share of the company as existing shareholder or to sell the shares of the company as existing shareholders or to buy shares of the company as a prospective shareholder. So this is called what? This is called key concepts of the agency theory. Any question? Okay, then we have stakeholder theory. We have already discussed all the stakeholders and their preferences. We will just overview all this. Basis of stakeholder theory is that companies are so large and their impact on the society so pervasive that they should discharge accountability to many more sectors of the society than solely to shareholders. It means they are not only to need to satisfy the expectations of their shareholders, but they are also expected to satisfy the need of all the stakeholders. Stakeholders are not only affected by the organization but also affects the organization. For example, management is protecting the interest of shareholders, but they are expected to provide quality product or services to the customers. They are expected to provide value for money to the customers, which they promise. They are expected to pay timely to their suppliers, and there must be a new order to the supplier. They should satisfy the needs of the employees. Employees want what employee want job security. They want consistent salary. These are the two basic expectations of the employees. Apart from this, it is responsibility of the management to think about future generation by investing on sustainability on green issues. They will incur their resources on the greenery. So this is called thinking about the future generation. They will contribute towards the community in which they are doing business from where they are earning revenues and making profits. So they will pay back some benefits to the society or community as a corporate social responsibility, or they will not be involved in any kind of activities which are illegal activities which can create concern of the community, and they will follow the laws and regulations which government expects from them to follow. They will pay tax on time. They will not try to avoid the tax. They will basically try to take the benefits of tax exemptions which are given by the government, but they will not try to hide the tax. So these are the different stakeholders and their different claims over the company or expectations from the company. Any question related to stakeholder theory? Apart from this, you can write here pressure groups. As I told you that it could be environmental groups, it could be labor union. So there are different trade union. So there are different pressure groups or different stakeholders. Lastly, we have stakeholders claim from this chapter. Stakeholder claim means what stakeholders expects from you as an organization to perform. So I have already discussed that what are the direct claims or what are the indirect claims made by the stakeholders directly with the organization and are unambiguous. Trade union asks for the rise in labor salary. They expect from the organization to provide job security to the workers, to the labor. They have their own voice. They are the influential people, or we want, it is expected from the organization to keep them satisfied. Because if they are dissatisfied, they can create a problem for the organization through strikes or any other kind of agitation they can do. Where the stakeholder is voiceless and individual customer is a voiceless because he is not an influential on the organization. Maybe his total revenue or his total purchasing from the company is in decimals. So cannot individual customer cannot influence the organization of a large retail organization. Like if you go to any large retail store, you won't be able to influence the management of the store or the environment with the inevitable problems of interpretation. So it is not possible for you to influence the organization to invest on the environment until or unless it is not the legal requirement. If it is not a legal requirement, then it is not possible for you to influence the management. So you can encourage the management through codes of practice or code of ethics, but you cannot force the management to do this. So these are called what these are called indirect claims or voiceless claims. So we expect from the management that management will not only focus on the direct claims, but management will also satisfy the needs of the indirect claims. Right? Any question? Okay. So we have finished